Currency Risk with Options, by Jim Walker, www.optionstradingeducation.com. Investors and traders purchase options contracts in order to lock in opportunity at a reasonable price and to hedge risk. Those doing business across national borders commonly reduce currency risk with options trading of foreign currencies. Foreign currency options trading is also used by currency speculators in search of profits amid market volatility. Although currency speculators look for market volatility, a company buying or selling products internationally would often prefer a quiet currency market. When that is not the case, they reduce currency risk with options trading. How is that done? Options trading in the Forex market. Because international companies must trade foreign currencies, they engage in Forex options trading in order to reduce currency risk. Foreign currencies are traded one versus another. Thus it is not the value of the US dollar or yen versus gold or commodities that one is concerned with in trading currencies. It is the relative value of the dollar versus the yen. A practical example in which a company might choose to reduce currency risk with options trading might be that a Japanese airline is going to buy a Boeing 787 Dreamliner. It will pay Boeing in US dollars. This plane costs around $200 million. If the cost of the dollar versus the yen goes up 1% between when the contract is signed and when payment is made, it will cost the airline $2 million. Because the relative value of the USD versus the yen can easily vary by as much as 5% over a few months, this is a very apt example. A 5% difference could amount to $10 million. The hypothetical Japanese airline has a couple of choices. One is simply to buy dollars with yen at the time that the contract is signed. But they may not have the cash or wish to borrow from the bank and pay interest. And the dollar may well fall in value versus the yen, which would make waiting to pay just in time a profitable action. The other choice is to enter the Forex market and buy calls on US dollars with yen. When our hypothetical company chooses to reduce currency risk with options trading and buys a call contract, it does not obligate itself to buy dollars with yen. It purchases the right to buy US dollars with yen at a fixed price called the strike price. When the company does this at the time of signing the contract for the aircraft, it locks in the right to buy US dollars at that price throughout the duration of the options contract. If, in fact, the US dollar becomes more expensive, the company can execute the contract and purchase dollars at the old price and not the new and more expensive price. If the dollar does not change or falls in value versus the yen, the company will have paid a little insurance and will let the contract or contracts expire, on their options expiration dates, worthless. In the event that the dollar has fallen in value compared to the yen, the company will end up paying less in yen than originally expected. It arrives at this excellent situation because it chose to reduce currency risk with options trading and not convert currencies in advance. For more insights and useful information regarding options and options trading, visit www.optionstradingeducation.com. By www.optionstradingeducation.com.